Dumela. Today we will be doing debtors allowances, how we account for debtors allowances adjustment. I will start with the definition. Debtors allowances results from returns by customers and allowances given to customers. Basically, when a customer returns goods, that will be regarded as debtors allowance. An allowance is simply a reduction of the purchase price. The original marked up price will be reduced, and that reduction is called an allowance. A customer will normally be given an allowance when they purchased goods from us, but those goods were damaged. Instead of us taking those goods back, we will simply give them a refund or an allowance, which is a reduction of the original amount that they paid for those goods. Now, for an allowance only, it hasn't changed, just like you learned in grade 10. You will not have cost of sales. For an allowance, you will not have cost of sales. Another allowance is when you were overcharged on the invoice as a customer. So we overcharged you as a customer. So we are going to reduce what you overcharged you by a certain amount, and that reduction will also be regarded as an allowance. Another example of an allowance will be where we omitted to give you a discount when you were supposed to have given you a discount. In that case, it will be regarded as an allowance as well. Now, that will be obviously a discount allowed. So you have an option of including that under discount allowed, because it's an allowance, so you are allowed to include it under discount allowed by increasing your discount allowed expense. However, another option is simply to record it as debtors allowance. Note that debtors allowance will be offset against sales, so it will reduce sales, as it simply informs you that the original amount of income that you assume that you have earned from sales, you actually did not earn it because those goods were returned to us. A customer may return goods because goods sold to them are damaged, not according to order, or of inferior quality. Allowances are made due to errors in the invoice, and I have explained that a customer was overcharged. The bookkeeper did not deduct the discount allowed to the customer from the selling price of goods sold on credit. Okay. What do you do when you come across an allowance, especially when goods are sold on credit? It will reduce what the debtors owe us, in essence, all right? But I'm going to start first by showing you what happened when we sold those goods. When we sold those goods to customer on credit, we debited debtors control and we credited sales. Debtors control is an asset, sales is income. But when those goods are returned to us, we have to reverse that transaction. If we were to reverse this transaction according to how we recorded it, we were going to debit sales and credit debtors control. Did you get that? However, accounting doesn't allow you to do that because you need to account for your debtors allowances. You need to know how much of your sales were allowances. And when you include it as part of sales, you will not be able to figure out how much allowances you had for the year. Allowances simply enables you to check if indeed your supplier is supplying you with good quality goods. And the higher the allowances, it means that your supplier is not supplying good quality goods, and you probably need to change suppliers or simply talk to the supplier. Now, we are simply going to debit, instead of debiting sales. Remember, sales is income. So when it decreases on the debit side. Instead of debiting sales, we are going to debit an expense account, which is, i.e., reduction of sales, which we refer to as debtors allowances. And then we're going to credit debtors control because these people have returned goods. Therefore, when they return goods, what they owe us will decrease. I'm simply showing you that debtors allowances is simply a reduction of that sales figure. So all we're doing is simply debiting it, but we don't debit it to sales, we debit it to debtors allowances. When we do closing transfers, that's where we are simply going to close debtors allowances to sales. However, we need to show it separately. We need to disclose debtors allowances separately so that we can continuously and accurately monitor our debtors allowances, because debtors allowances reduces what we have already earned, which is sales, and that is not good. Now, I normally get this question: what happens if you bought goods for cash? Are you allowed to return goods? The answer is yes, you are allowed to return goods. When goods you purchase and you purchase them for cash, you are allowed to return goods. But obviously, you need to keep the original slip of the purchase. Now, accounting for debtors allowances in the financial statements. Debtors allowances account is treated similar to an expense account. It increases on the debit side whenever a customer returns goods or when a customer is given an allowance. I have explained that, so I will not explain it again. I explained it in the previous slide. Now, debtors allowances figure that you get in the pre-adjustment trial balance. What do you do with that one? The debtors allowances figure that you get that is reflected in the trial balance must be deducted from sales amount. No need to calculate cost of sales, as cost of sales, when it comes to that amount, has already been taken into account. The fact that you've got debtors allowances in the trial balance, it simply means that cost of sales that relates to that debtors allowances have already been taken into account. So no need to calculate cost of sales on the debtors allowances figure that is given to you in the pre-adjustment trial balance. Highlight that because that is very important. So your only duty is to subtract the amount from the sales figure that you have and also subtract that amount from debtors control. Okay, in this case, actually, you don't need to subtract it from debtors control because that has already been taken into account. The fact that it's there in the pre-adjustment trial balance, it has already been taken into account. This only relates to debtors allowances amount that is reflected in the pre-adjustment trial balance. What about debtors allowances amount that appears under adjustments? If there's a debit note or credit note omitted by the bookkeeper. Now, what is a debit note or credit note? The debit note or credit note is a source document for when goods are returned. Can you use either or? Yes. As long as it's a debit note or credit note, you can use either as a source document. It's just that the other one is given to us by the customer and the other one is the one that we give the customer. Okay? But they relate to the same transaction. As long as the return of goods has been approved, you can simply use either as a source document. What are we going to do when this debit note or credit note has been omitted by the bookkeeper. It simply means that our debtors allowances that we have in the pre-adjustment trial balance has been overstated. All right? Debtors control have been overstated. Sales have been overstated. Trading stock has been understated. And cost of sales has been understated, actually overstated in this case. So we need to reverse all of those. So what do we do when the credit note or a debit note has been omitted? Okay, these are the steps that you need to take. Decrease sales by the selling price of the amount of goods returned. Remember, when you debit debtors allowances, you're reducing sales. So you will simply need to debit debtors allowances. That's how you reduce sales. And debtors allowances at the end will be subtracted from sales. You also need to decrease debtors controllers. That means that by the selling price, by the way, as goods has been returned, it means that your debtors will owe less. Note that debtors will always owe us the selling price of goods we sold to them. So whatever goes under debtors control must always be at selling price. So the first one, we are going to debit debtors allowances. That's how we reduce sales. It is the contra account to sales. So basically it reduces sales. It is the opposite of sales. Sort of like, just because it's debtors allowances, people think now, no, it is about debtors. No, it simply is an expense account which reduces your sales. And then we are going to credit debtors control assets. When they decrease on the credit side. Both of those will be at selling price. Okay, I'm done with those. Now I'm going to do the ones that will be affected by the cost price. You will reduce cost of sales. You will reduce cost of sales by the cost price of goods returned. If you are given sales amount only, use the given markup to calculate the cost price. By now you should know what to do when you are just given the selling price and you only have the markup and you need cost of sales. If you're still confused, please check out a video on debtors journal. I think it's lesson 7, if I'm not mistaken, where I showed you how to calculate cost of sales, sales or gross profit when you're given the markup. Complete that table and then come back to this video and you should master it after watching that video. The last part will be to increase trading stock by the cost price of goods returned. We reduce cost of sales. Cost of sales is an expense. So when they decrease, when cost of sales decrease, they decrease on the credit side. And that is at cost price. And then we increase trading stock on the debit side because it's an asset. We increase trading stock on the debit side because assets increase on the debit side at cost price. Someone might be asking me, why are we increasing trading stock? We are increasing trading stock because we are getting it back. But you need to read the question carefully because sometimes the question will tell you that goods that were returned were damaged and we had to return them back to the creditor. So it means we're going to add trading stock and minus the cost. We add the cost price and minus the cost price. So the net effect on trading stock will be 0 when those goods are returned to the supplier. But if nothing is said about the goods being returned to the supplier, you will simply increase trading stock at cost price. We good? Now note this. Some allowances will not have cost of sales, e.g. discounts omitted. Alternatively, omitted discounts will be recorded at discount allowed and the operating expenses. I think I've explained that. Now, here's another thing, guys, that people confuse with debtors allowances. When a credit sales invoice has been omitted, know that a credit sales invoice is issued to a customer when the customer buys goods, purchases goods on credit from us. So when the customer purchases goods on credit from us, that is not debtors allowance. That is an actual sale that needs to be recorded in debtors journal. All right. But obviously, since it's been omitted, opening up the debtors journal and correcting the debtors ledger, and from there correcting the debtors control, we are at the end of the financial year. We need to complete our financial statement. So for now, because I'm in a hurry, probably there is a software that when you correct it, when you enter it correctly, it'll correct everything automatically. You won't have to go and physically insert it. All right. But because we are busy preparing financial statements, and we are in a hurry, this is the end of the financial year. We need to make sure our financial statements are up to date so that the external auditors can come and check if everything is accurate. I will simply enter it in my debtors, in my general journal, and it will simply have the same effect. But I'm sure that you can, if you want to, record it in the debtors journal. All right. So this should be going to debtors journal in essence. And when it goes to debtors journal, you will simply debit debtors control by the selling price and credit sales by the selling price. And then debit cost of sales at cost price and credit trading stock at cost price. Remember, these four transactions always go hand in hand. Whenever goods are sold and whenever goods are returned, you must just check if there's sales or debtors control. Those go hand in hand. Cost of sales will go with trading stock. Cost of sales increases on the debit side whenever goods are sold. Please also check out the video on debtors journal where I explained cost of sales, the general ledger. Go back to that and make sure that you familiarize yourself with that. Okay. If you're confused, if you're not confused, let's move on. Let's move on. So you will simply debit debtors control by the selling price, as it means that debtors will owe us more. All right. So you credit sales at selling price, you debit debtors control at selling price. And then you debit cost of sales at cost price, and then you credit trading stock at cost price. Cost of sales will always go up on the debit side whenever we sell goods. So basically, sales will always be on the credit side whenever we sell goods, but at selling price. Cost of sales must be on the debit side at cost price. So those two must always go hand in hand, because when you recognize sale, you need to match it to the actual expense incurred. And the actual expense incurred will be cost of sales. That enables you to calculate what we refer to as gross profit. We good? With all that theory that I just gave you, in honest truth, you should be able to nail every question that you come across just by reading that theory and making sure that you understood it.